I mean, it's not that difficult. Just look up Wall Street bets on Reddit, find out what people are investing in, and invest all your money into those things, and just watch the money start rolling in. Please don't do that. You're probably going to lose a lot of money. My name is Dave Dimitra, and I'm a college student, and I'm here to help you understand finance. So the reasoning for making this video is that many people have tried to make these kinds of videos in the past, step-by-step guides, processes on how to start investing, but none of them have been through the perspective of a college student. Now, most people, when they start investing, like myself, they're either in their early 20s, late teens, and they kind of want to get a feel for investing. But the problem is, the guides and step-by-step processes you see on YouTube are meant for people who understand what they're doing. They're not really step-by-step, and they don't explain why they're doing what they're doing. It's just kind of telling people what to do. So I'm here to change that, and I'm giving you my advice on what I did. So there's two things you need to know. Number one is you don't need a lot of money to start off with. You've probably heard this millions of times before, but it is true. You don't need a lot of money to start off with depending on what you do. And number two is you don't need to understand terminology just yet. Many people have tried to teach terminology to newbies, beginners. It does not really work out. I'll explain to you why in a little bit. So before I start off my step-by-step process, I'm going to give you guys an article I read previously. So in 2020, a guy made something called a random stock portfolio. This was an experiment to see if the market was really random. Now, you've probably heard of the famous one where a couple of monkeys threw darts at the Wall Street Journal, and a couple of investors made a stock portfolio based on the darts that the stock landed on. And it turned out that did end up performing better than what people on Wall Street were doing and investing in. So it kind of leads us to the random walk hypothesis, which is a financial theory that states the stock market prices evolve according to a random walk per se, and it cannot be predicted. But this guy, he randomly generated a portfolio and invested in those stocks and it tracked their progress for a year. A year later, he checked, and it turned out it performed much better than the average investor. So it kind of goes to show that you can't really predict it, even though some people do try to. What can you do to use this as your benefit? So let's get started on the step-by-step process. The first step is you have to understand the mentality it takes. First things first, there is no 100% guarantee. There's ways you can increase your chance of profit, but that's about it. If you ever see a video or an article saying, do this, invest in this, and you are guaranteed profit, exit out of that video, exit out of the tab and the article, because they're lying to you. It can't be done. If this was that easy, everyone should be investing because it's guaranteed profit. Don't put money into someone's course. They know just as much as you do. As I said, it is random, so it does not work. You also have to assume when you invest, all your money is gone. It's like a purchase, because if it does go down a little, you can't be stressing over that kind of stuff because stocks will go up and down all the time. Consider it's a purchase and just leave it at that. There's multiple paths you can take when you start investing. You can try individual stocks, index funds, day trading, penny stocks, option trading, etc. But what should you do? And most importantly, what's the best chance of you making money in the long run? And in my opinion, not a financial advisor, the best way to make money is investing in long-term assets. So let me explain why. Number one, and one of the most important ones, is it does reduce risk. You don't have to worry about the volatility of a stock if it goes down a bunch in a week, if it goes up a bunch in a week, because you're not investing and cashing out in a week. You're holding out 2, 3, 4+ years. So that 6-month range on what it does between then, it does not matter to you, and it's less stress as well. Number two, you pay a lower capital gains tax. If you sell a stock after holding it for a year plus compared to you selling it within a year, you pay less capital gains tax. And number three, you get better long-term returns. The S&P 500 has returned a historic annualized average return of around 11% since its founding in 1957. And I go by this famous Warren Buffett quote, which is, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And it's something I've lived by, and I've continued to do so. This is especially good if you're a college student, because you don't have time to just check on a stock on a daily basis to see if it's going up or down. It'll save you time, save you stress, and you can use that time to put more of your effort into studying or taking tests, etc. Now that we know that, what's step 2? Figuring out what to invest in. When you purchase a stock, try to find out how much you can afford to spend, your risk tolerance, and what kind of goals you may have. Some individual stocks, like Coca-Cola, pay out dividends where the company pays its shareholders regularly a portion of its profits. For example, say if you own 15 shares in a company, and that company pays you $2 in annual cash dividends, you will receive $3 per year in addition to still holding the shares. But keep in mind, not all stocks will give out dividends. The safest option would be to hold index funds such as the S&P 500 or VT-SAX. Unlike stocks, these funds come with a lower cost, and you don't have to choose specific companies to invest in. They come in a whole package. For example, if you spend $100 on the S&P 500, that $100 is spread out across 500 of the largest publicly traded companies in the US. Even if some of the companies in the S&P 500 are red, if some are green, it'll balance out and you won't be at a loss, which does minimize your risk. You can choose to keep contributing to the fund and buying what you can afford into the fund, and odds are you will beat the average investor. Not a guarantee, but it is safe. If you want to be a little riskier, you can invest in growth stocks. A growth stock is a company that generates positive cash flow and whose earnings are expected to increase at a faster rate than the average company, such as Tesla. So what should you do? My recommendation is to have a little bit of everything. Have 50% of your portfolio an index fund, and split the rest 50% with some blue chip stocks, which is high value stocks such as Microsoft, Google, and growth stocks. Some companies can be considered a blue chip stock and a growth stock, but if you want to play it safe and minimize your risk even further, you can put your entire portfolio into index funds and it worked the same. Now you have a general understanding on what you should invest in and the types of investments you can make in your portfolio long term. How do you actually do it? This leads us to step 3, which is actually purchasing your share. I won't show all the multiple ways you can buy a share. What I will do is arguably more important. I'll show you all the ways to secure your investment to make sure it can never be stolen or hacked or taken away from you. You may have heard one of the more popular sites like Robinhood being hacked and people losing access to their accounts, people not being able to withdraw their cash, their investments, etc., which has made millions of people lose money. And even to extreme cases, people have taken their lives. Fortunately enough, you can take measures to ensure your investments are safe and secure, so you can ensure it never happens to you. Since we are investing long term, I would recommend using M1 Finance. I personally use this myself and have encountered no issues. I'm not sponsored by them, not affiliated with them, but I do recommend this for anyone. And if you want to check out my video on the best investing apps, I did say this investing app was the best to use if you are looking to trade long term. So some info regarding these apps. So on every investing platform, there are 2 main laws that it must comply with: KYC and AML laws. KYC stands for Know Your Customer, and it refers to the checks a company does to make sure the customers are who they say they are and it doesn't pose a risk to the business. AML stands for Anti-Money Laundering, and it's something that they do to prevent criminals from depositing or transferring their funds to contribute to their illegal activities. It's essentially there to prevent things such as terrorism financing, etc. The KYC laws do fall under AML laws, but they're used in the same way essentially, so you can use them interchangeably. So when you do open an account on any investing app and you find out the basic info and they're asking your address, your SSN, etc., this is what they're for, so they can comply with those laws. After creating your account on M1 Finance, it's going to ask you to confirm your email address and tell you to connect the bank account you want to use to deposit your funds. It will give you the option to select an account type. Since you will be the only one investing, you will be opening an individual investing account. But before we go any further, we want to make sure this account is secure. Go to the Play Store and download Authy. This app is a 2-factor authentication app that changes the code every 10 seconds. Again, I'm not sponsored by them, and I personally use them. I've never encountered an issue. Create an account and go to your settings, then devices, and turn off allow multi-device. This will prevent anyone from going into your account unless they're from that specific device you opened the account with. You can always choose to leave it on if you want to connect multiple devices, but for this purpose, I would recommend to turn it off. Now open M1 Finance again and go to settings, security, and enable two-factor authentication. Connect your M1 Finance account to your Authy account by filling out the code on the Authy app. Now, no one in the world can log in to your account unless they have your specific phone. You can also make sure your Authy is more secure by enabling your biometrics into the app, so you can make sure the only people who can log into your investment account is if they have your biometrics or if they know the PIN code on the app. This makes it very hard for a hacker or anyone to log into your investment account because they would have to have your phone in their possession for them to access your account. Anytime you want to log into M1 Finance, it will prompt you for your code, where then you can load up Authy, type in and copy the code onto the app, and you're into your own account. Now that we have assured that the account will be safe and protected, you can create your own long-term investment portfolio, or what they call a pie. So I'm going to make the portfolio with you guys so you can see the step-by-step process on how to make your portfolio, adding pies, how to create a slice, and how to deposit your money into M1 Finance. So this is my portfolio. We've named this long-term, and we're going to make our funds. As I said before, we're going to do the same one I mentioned before. 50% of the portfolio is going to be index funds, 25% is going to be individual stocks, and the other 25% is going to be growth stocks. What we're going to do is we're going to create a pie. Let's go and create a pie. Label this index funds. Press done. Alright, so new pie created. Alright, we're going to create another pie. Label this one individual stocks. Alright, and the final one, and we're going to name this growth stocks. Now that we have our three individual ones, right, you have to put the stock into these pies. So we're going to click on index funds, and on the right side there's something called add a slice. So you have a variety of stocks, funds, people that you can invest in. If you go to expert pies, you can plan for retirement, you can invest in a hedge fund. Berkshire Hathaway is a popular one. You can invest in their portfolio. Their historical returns are very good. Tells you how much risk they have, etc. But for this one, we're gonna do something simple. We're just gonna invest in the S&P 500. So as you can see before, it's sorted by our market cap. So as you can see, the S&P 500, we're gonna press the plus sign and click done. So as you can see before, in index funds, 100% of the portfolio is going to be in VU, which is S&P 500 index fund. I'm gonna go back, all right, and go and click on individual stocks, add a slice, and there are a variety of ones you can invest in. So I used to work at Home Depot, so let's invest in Home Depot. All right, we can also invest, if you have an Apple phone, you can invest in Apple, very, very safe company, good company to invest in. And as well as that, if you want, you can invest into something I truly believe in, which is Nvidia. We're gonna click done, and as you can see, it gives you a balance, 100% balance based on the stocks. So you can customize these percentages too. Say you want more of the investment in Apple, you can put this at 50 and the rest at 25. So most of the portfolio is Apple. As long as the percentages equal $100, you're all good. So we're gonna click close, and you can see it's been edited where Apple has the majority of the shares. We're gonna go back and we're gonna add some growth stocks now. So Tesla is a really, really popular choice. So we're gonna add Tesla. As you can, Tesla is right there. We're gonna click done. And if you want to add more, like I said before, you can add more, add a slice, etc. and balance percentages based on what you want to invest in. I'm gonna go back, and now you can put percentages on your pies. So as I said before, index funds, 50%. So we're gonna label this as 50. stocks, we want to invest more in stocks because they're more safe, obviously. We're going to make the individual stocks more than growth stocks because the individual stocks are a bit safer because they are blue chip stocks. So we're going to put this at 75%. We're going to put this at, let's say, 30%, and the growth stocks at 20%. So, as you can see, the portfolio is set. You have index funds at 50%, which is the S&P 500. You have individual stocks, which is set, and growth stocks, which is set. Now we're not going to press continue because this will change my portfolio. So we're going to press close. We're going to press the X again. And now that you know how to create a pie and create your own portfolio, I'm going to show you how to invest. So as you can see, there are multiple tabs down here that you can click on. All right. So we're going to go to that. You see how it says buying power and deposit. Swipe up on that, press deposit, and you can connect your bank account or your credit card and deposit it into your individual and your account number. The minimum amount you can transfer is $10. After you transfer that amount in, it's going to show how much buying power you have. You can choose your auto invest feature. If you have dividends or something, you will get a cash balance, which is currently 18.39 for me. It'll keep coming in, and once this value reaches above $25, as this says, $25, it will automatically invest all the cash into the balance. And for you, it should say something different. It'll tell you when your trade window is. If you have M1 Plus, they'll give you an afternoon time as well. But at 8:30 a.m. tomorrow morning, all your investments will go in, and you should see something like this. And you can see a day-by-day period and sort by how you want to see your profile and your data in the profile. So that's basically it. I hope this kind of explained in depth my step-by-step process on how to do this as a college student, so you can relieve yourself of some stress and the struggle that comes with investing for the first time. You don't need to learn any new terminology, know nothing. This way you can step your foot into the whole world of investing, and hopefully if you follow and subscribe and use the tips and tricks I teach you guys and use it for your own benefit. If you enjoyed this video, make sure you subscribe, like, and turn on post notifications so you don't miss another upload. This is one of the biggest videos I've made, so hope you guys enjoyed, and I'll see y'all later.